Okay, good evening, everyone. This is a recorded session. So, just before this lesson, we were going through securitization. More particularly, we were going through the topic of structured financial products. For your purpose, let's go through that. So, before structured finance product, we went through financial market service providers. In structured finance product, we were looking at, first we looked at what structured finance meant, how it was a bit different from our conventional debt and equity sources. Here I have reiterated to you that structured finance product are certain products which are tailor-made, engineered for specific risk appetite, risk return appetites. Okay, so under structured finance product, you get securitized, collateralized products, and also derivatives fall under this category. Okay, and the heart of structured finance is securitization. What is securitization? It's the process of bundling receivables which were illiquid before and convert them into liquid assets so that cash and capital could be freed. Okay, how this structured finance came about? The starting point was on the difficulty of managing mortgages which were of a longer term. Okay, having long-term mortgages tied up a lot of cash for the banks, and because of the high time involved in that, there was a lot of high risk exposure to by the banks, and that required them to keep a lot of capital aside as well. Okay, so to address these issues and to free up the cash tied up is where structured finance product actually came about. So under securitization, we saw how securitization works. There were 4 steps. First was to identify a certain portfolio that you wanted to get out from your balance sheet, and then to pool that receivable and transfer it to another party called SPV, special purpose vehicle, for legal and tax reasons. And the SPV who gets this asset will use this asset and issue debt securities and collect money, and this money will be paid in return to the asset which were transferred by the company. So the company will get the cash in the end. Okay, and what will the investors get over the investment time period? Whenever the underlying asset, which is the receivables, whenever they collect the receivables, they will pay the collected repayments to the investors as their return. And in case of a default, the asset has a collateral, right? The loan has a collateral, a house or a vehicle per se, that will be used for recovery. Okay, this is how theoretically securitization works. And then there was a doubt that was questioned. At that time, I told you how it practically works. Even though theoretically we say it's a legal transfer to the SPV. What do you mean by a legal transfer? The company which is transferring the asset will not be the owner anymore. The ownership will be passed to the SPV who will now own and manage it. Okay, but practically what happens is, even though SPV gets the asset, they impose a condition on the company saying, look here, if one of these assets goes bankrupt, you need to replace it. You need to replace that loan with another new loan. Okay, so when there is a replacement clause, can the company get out of this arrangement? No, they still have to be involved. Okay, therefore the bad loan will have to be transferred back to the company and to the bank, and then a new loan have to be transferred to the SPV in return. That's how it practically works. It's, think of a scenario of factoring with recourse and without recourse. Okay, so securitization works in such a way. Why do you need a SPV? To legally transfer the asset to them, so that the general creditors of the originator or of the company who's transferring the asset cannot claim on that asset. And also the SPV, because it's a new entity with no any other obligations, they are able to get a better credit rating to the securities that are issued backing the asset. Because if the originator themselves try to issue the debt security, depending on their asset, their debt liability or obligation is how the credit rating is given, correct? Now this is a brand new entity incorporated only for this purpose, so they don't have any other loans. Okay, so when they are going to issue a securitized debt instrument, a collateralized debt obligation, then they can get a better credit rating for that instrument. That's why you have a SPV coming in. What is tranching? Yes, you pool a asset pool and offer it, so that backing that they could issue the debt instrument. But in this asset pool, there can be different classification of different types of risks. Okay, different classes of risks. So in tranching, you are breaking them down according to different risk categories, so that it is better suited for the risk appetite of the investors, and the high risk component will not impact the low risk asset classes. Okay, and that will allow them to get a better credit rating. If you have all the assets, all the loans and advances in one group and go for a credit rating, it's a credit rating given on average. Okay, so the entire portfolio might end up with a triple C or a double B. But if you tranche it, if you group the asset classes according to the risk types, the low risk categories can get a higher credit rating, and a high risk category can end up with a low credit rating. And depending on that, the return can be decided. Okay, that's why tranching is recommended. Tranching allows you to tailor make the instrument according to the risk appetite of the investor, and also to get a better suited credit rating. Okay, who are the participants involved? Securitization, we saw that as well. You in every securitization, commonly you will definitely see an originator. Why? They are the ones who had this asset in their books, created due to the regular course of business. Okay, and now they want to get out of it, they need to sell it off, free up the cash. They are the originator. Then you have the trustee. When you have several investors, to protect the interest of the investors, you have one nominee to represent them all, that is trustees. And then you all of course see investors. They are the ones who actually invest in the collateralized debt obligation or the securitized debt instruments. Okay, you can even include SPV into this, because they are also a participant to this arrangement. Okay, so those four are definite must. Others you would see on and off in certain arrangements. Credit rating agencies come in when you go for a more public type securitized debt product. Then you have a credit rating agency coming in, going through the credit positions, issuing ratings to the SPV and to each tranches. Other than that, the other four, their involvement varies according to the situation, but nevertheless, they are there in the arrangement. You have arranger who will come in to help the originator, so that they can transfer the liabilities, and also market that particular tranche so that investors will purchase it. What does a servicer do? Servicer is in charge so that they can collect the repayments of the loan, and also to track the asset performance, the pool performance, whether they are being paid correctly, whether the risk levels have increased or not. Those are tracked by the servicer. Asset manager, they will manage the assets that are granted to the SPV. They will decide whether they need to get more collateralized asset or they can get out, or they could remove the collateralized asset. Okay, so the entire asset management comes from the asset manager. Financial guarantors, what are they up to? They will guarantee the repayment of principal and interest to the investors for certain tranches. Obviously, financial guarantors will not come in and guarantee repayment of capital and interest for the high risk category, because it's high risk. Most probably it will materialize. Usually they give such guarantees to the low risk tranches. Okay, so in that situation you will have financial guarantors also stepping into this entire arrangement. We saw the exam, we saw the diagram. It's also in your note. In that, the entire arrangement was there. Initial starting point is the originator. If there is a arranger, originator can approach the arranger, and the arranger can help the originator structure the SPV, structure the tranches, and also market them. Okay, so the originator will sell down the asset, transfer the asset to the arranger, and they in turn will create the SPV and transfer the asset to them. Asset is parked here. Once SPV gets the asset, they have to pay for that asset, correct? But they are a new entity, they don't have cash with them at the moment. Therefore, backing these assets, they will issue certain debt instrument. That's what you call securitized debt instrument or collateralized debt obligation. Okay, so these are then given out to investors in tranches, so they can invest in. The cash will come in from the investors. You can see that here in the red line. Cash will come in from the investors to the SPV. SPV in turn will take that money, give it to the arranger. Arranger will deduct any fees that's payable to them and remit the net amount to the originator. Okay, this is the core of the securitization process. Then we saw the others who are there to support this. You have servicer looking into the assets so they can collect and track the performance. Asset manager managing the asset pool. Financial guarantor to ensure certain tranches. Trustee to monitor compliance. And then you have rating agency to evaluate credit risk, deal structure, and assess third parties, interact with investors, and also issue ratings to the SPV or even to the tranches. Okay. Then we saw the types of securitized debt instrument. In other words, here, securitized debt instrument meaning backing this asset, you will give certain debt instrument, correct? Those are called securitized debt instrument. These debt instruments can be of two types. And these two types depend on that backing asset. Okay. If that asset is a mortgage loan, then this debt instrument is called mortgage-backed securities. If the asset is a non-mortgage asset, then it is called asset-backed security. Okay. So you have two types here for you. If it's a pooling of mortgage loans, it's mortgage-backed securities. If it is pooling of non-mortgage loans, what do you mean by non-mortgage loans? I told you, mortgage meaning housing or home loans. So any other loan which is not a housing loan can be used for a asset-backed security. It can be auto loan, credit card receivables, any other receivables. Okay. Remember, they are not only the collateral for you, and they are not only the collateral here for you, they are also the means for interest repayment. When the loan repayment comes in, you will use that proceed to repay the investors. Okay. If there's something bankrupt, then the loan security will be used as the security for the investors. So remember that. What is the similarity between MBS and ABS? Both of them are structured finance product, or both of them are result of securitization. Other one is both of them could have tranching structure. The instrument, the security could be sold in tranches, and both of them are subject to prepayment risk. The underlying loan could be prepaid. What is the main difference? The difference is the collateral, or the type of loan that is backing this instrument is the main difference between MBS and ABS. Then we moved on to credit derivatives. In credit derivatives, what we were looking at, it's also another structured finance product. But here, what are we engineering? We're trying a way to transfer credit risk. What is credit risk? Credit risk is the probability that your investment will not pay you back, or your investment will be lost. For a bank, what is the credit risk? The borrower defaulting. Okay. For an investor, what is the credit risk? The investment not being repaid. Okay. So how can you transfer or treat this credit risk? So to treat that credit risk, credit derivatives were introduced. So the value of the credit derivative depends on this underlying transaction. If you have a loan and you are exposed to credit risk, for you to get out of the credit risk, you will use a derivative. So the value of the derivative will depend on the underlying transaction. Okay, remember that. So in types of credit derivatives, you have collateralized debt obligation as the main type. What is collateralized debt obligation? That is what we saw earlier. It's a structured finance product which is backed by a pool of loans and assets. The underlying asset of that loan is going to be the collateral in case the loan goes bankrupt. Okay. You have CDOs as a way to transfer the credit risk and to free up the capital. By using that, they are able to transfer the credit risk from one entity to the other. Even though this is the elementary product, you have certain complex products when it comes to credit derivatives. Credit default swap, total return swap, credit linked notes. Okay. Easier way to remember credit default swap is something like insurance. Why? I explained you when we went through this lecture as well. Think of yourself as an owner of a vehicle. If the vehicle meets with an accident, you as the owner has to bear the loss or the repair cost. But if you have got insurance, your insurer will have to bear the cost of repair and you will be reimbursed. So even though a repair happens, you are now safeguarded. Okay. It is the insurance company that will bear the cost. Why is the insurance company willing to bear the cost? Because you have got an insurance, which means you have to pay annual premium. Okay. So let's say every year you pay a premium whether accident happens or not. Let's say the car that you got had no accidents at all. Then the insurance company is very, very happy. Why? All the premium that you paid is their return. They didn't have to pay anything back to you. But let's say you are paying a premium, but frequently you are getting along with scratches, minor accidents. Okay, that will require the insurance company to keep reimbursing your repair cost. That's why they ask you the times or the rate of accident so that they can determine the premium, whether they have to increase the premium. Correct? Your claims, the number of claims determine the premium for the next year. Okay. Why? If the reimbursements are high, then they know they have to increase the premium. If this, You keep withdrawing the money. It's unprofitable for them. Okay. Just like that, you have credit default swap. Here, you're swapping the risk of credit default. Credit risk is being swapped to another entity, transferred to another entity. If you are an investor who has invested in an asset which has to pay you your capital in maturity, interest in a particular time period, and then they default on that arrangement, your principal is lost, your interest is lost, then what happens? The investor is bound to bear the entire loss. Okay. So to mitigate that, if the investor wishes to get out of this credit risk exposure, or to cover themselves, protect themselves from such a default risk happening, or to protect themselves even though this event happens, they are compensated for the loss, they can approach a credit default swap. They could obtain a credit default swap. What happens there? Even if the investment is bankrupt and a loss situation occurs, they can claim on the credit default swap and go to the protection seller to get the compensation. Just like the insurance, okay? Just like the insurance, if they meet with if their investment meets with a loss, they can go to the protection seller for reimbursement of that loss. Why will the protection seller reimburse for them? Because annually they have paid premium. They have to pay premium annually. Let's say there was no default that happened during the investment maturity. Then the protection seller is very, very happy. Why? All the premium are their return. They didn't have to pay a cent back. That's what they hope for. Okay. So CDS, if you take CDS, does it eliminate credit risk? No. It only allows to transfer credit risk from the protection buyer to the protection seller. So when you buy protection, when you buy the CDS, you are protected from credit risk. And the credit risk is now transferred to the CDS seller. You can see the entire arrangement here visualized. So here you have a reference entity. This is the entity who would have issued a particular debenture in which you, investor, has invested. The investor has invested. Okay. So investor has to get the interest and the principal. Okay, as per the agreement. But if there is a default on this, who will bear the loss? Investor will have to bear the loss. Principal is lost. Interest is also lost. Okay. So to protect themselves from such a occurrence, they can get a CDS. CDS, who should they get it from? They should get it from a CDS seller. You can either call them CDS seller or protection seller. Okay, protection seller issues the CDS, sells credit protection. Okay, so when they sell the protection, the investor becomes protection buyer, purchases the credit protection. Okay, so when you get a CDS and a default happens, then payment is given to you from the protection seller to compensate for the loss. If there is no default that happened during that time, then continuously reference entity will keep giving the interest and the principal interest payment regularly, and the protection buyer has to keep paying the protection seller for the credit spread payments. CDS buyer pays premiums to the seller to ensure interest and principal payments from reference entity. To ensure the interest and the principal, they have to pay a premium to the seller. Okay, this is how the arrangement works. Let's go through this. May own underlying credit assets. So they are the ones who own they hold, let's say it's a debenture. So they hold this debenture. Okay. They are the one who purchases the credit protection. They are able to reduce the credit exposure due to the CDS. And here they have mentioned short side. What do you mean by short side? Short meaning selling. What are they selling? Invest protection buyer buys the CDS and sells the credit risk. They transfer the credit risk. Protection seller, they don't really have to own the debenture. They don't own the debenture, but still they're exposed to the credit risk. If this goes bankrupt, they bear the loss. Okay, why? They are selling the credit protection. And they are on the long side. What do you mean by long side? They buy the credit risk. Short meaning sell. Long meaning buy. By selling credit protection, they buy credit risk. Okay. That's how a CDS work. Now don't confuse CDS, credit default swap, with central depository system, please. Okay. Those two are two different, just the abbreviation is the same. So understand that these two are different. Okay. So in the case of a CDS, protection buyer is the investor. He or she is the one who's exposed to a credit risk. Okay, and they want to get themselves protected by this. Okay, so they buy a CDS and transfer the credit risk to the CDS seller. Okay, when they transfer the credit risk annually, they have to make a CDS spread premium payment. It's like an insurance premium. In the context of the CDS, you have protection seller. Who is protection seller? They are the ones who issue CDS, issue and sell CDS. Okay, they issue and sell the CDS and guarantee the credit risk of a certain issuer. Let's say even if the credit risk materializes, they guarantee on behalf of the issuer. Okay, even if something like that happens, we will compensate. Okay, so throughout this effective time, this protection seller will collect the premium and assume the credit risk. What do you mean by CDS spread? It is a percentage. Remember that this is not in amount terms, it's in percentage. It's the percentage premium that the CDS buyer has to pay to the CDS protection seller for 1 year. Again, remember it's annually, so it represents only 1 year payment. So how can you calculate the premium in amount? You have to first know the amount for which you are seeking protection. Let's say you have an investment of 100 million and you want to cover the entire 100 million. Then the amount to be protected is 100 million. CDS spread should be given, it's a percentage. So by merely applying the percentage on the exposure amount, you should be getting your annual premium. Okay. So by getting a credit default swap, you are able to protect yourself from the credit risk. The investor is able to transfer the credit risk to the CDS seller. You cannot completely eliminate credit risk from this entire arrangement, but it doesn't mean that the investor is protected from all risks. What is the other risk that they are facing? They will face counterparty risk. If you can just write it down here, note it down here. Risk to the CDS buyer is the counterparty risk. Yes, If the reference entity defaults, they will get their reimbursement money from the CDS seller. But when they go to the CDS seller and the CDS seller is also bankrupt, then the CDS buyer loses the investment, the interest and the principal, and also the premium paid to the CDS seller. Okay, so CDS buyer is exposed to counterparty risk. What if the other person doesn't honor that contract? Okay, what is the risk to the CDS seller? Risk to the CDS seller is they have something called jump to jump risk, which means if the reference entity defaults, then obligation to the CDS buyer is created. The CDS seller has to pay or compensate the CDS buyer. That's a risk for them. They don't want to pay. Even though they insure, what is their motive? They want to avoid paying the compensating the loss amount. Then the entire amount becomes their return, correct? So the seller of a default swap faces a jump to jump risk. If the reference entity defaults, CDS seller has to pay. And the other is if the CDS seller has sold protection to all the investors of a particular reference entity, and then the reference entity defaults, then it creates a much higher obligation to the CDS seller. Remember, I told the example where you have one reference entity who is issuing 1 billion debenture. Okay, 5 investors have bought. All 5 investors get the credit default swap from the same person. Let's say within months of issuance, the reference entity goes bankrupt. Then the entire 1 billion has now to be settled. 1 billion plus any interest has to be paid by the CDS seller. What if the CDS seller cannot bear that? Then it's a risk to the CDS seller. Okay. What were the other two types that we saw? Total return swap and the credit linked note. Total return swap covered 3 types of risks. In CDS, it covered credit risk. Here, it covers credit risk, in other words, a default risk. It also additionally covers credit deterioration risk and market risk. Okay. In addition to that, it covers 2 other risks as well. How does it work? An investor has a reference asset. Okay. He or she agrees that total return from this asset, which means periodic income and any other capital gain, any other appreciations or depreciations in the value of that investment, will be transferred to the protection seller. Protection buyer, what do they get in return? They will get a set rate. Now, in this example, it is floating. It can be fixed as well. They get a set rate in return. What is the risk that they are transferring? Default risk. Let's say this reference asset doesn't pay any income or defaults on that periodic payment, then again that risk is passed to the protection seller. Let's say there's a credit deterioration, there's a downgrade in the credit rating. Because of that, the asset or the return from that asset is impacted, is reduced. Again, that risk is also borne by the protection seller. Why? The total return goes to them. Market risk. Let's say this reference asset is an equity. The share price declines. Again, that goes to the protection seller. Okay. Protection buyer gets a set rate. They are not exposed to the market fluctuations or fluctuations that arise due to default or deterioration. All right. Now, looking at this arrangement, you will be wondering, why is protection seller actually giving protection to this protection buyer? Because he is at a disadvantage. Why would somebody do that? Because remember, this is volatile, right? Total return is volatile. It can go up, it can go down. Now, when it declines, they face a high risk. But if it increases, protection seller benefits on a net basis. Okay, so it depends on how the total return actually moves. And another one is protection seller. Now here, look at this. They get the total return, but they don't have to pay. They don't have to actually own these assets. So without making a substantial initial investment, protection seller now gets the right to enjoy the total return. Okay. Due to this reason, protection sellers are very keen on issuing total return swap. Okay. What is the similarity between a TRS or a TRORS? It is both CDS and TRS transfer default risk or credit risk. What is the difference? Difference is, even though credit default swap doesn't cover or transfer deterioration risk and market risk, TRS enables those risks also to be transferred. Okay, that's the major difference. Then we saw credit linked notes. This is also another credit derivative. It helps to transfer the default risk, credit risk, to another party. But not only credit risk, it also helps you to transfer the downgrade risk as well. Okay. Now let's see how this happens. Here, I have taken the image separately. Okay. Now, in a credit default swap, okay, I have both these diagrams here. So, in a CDS, we saw that if a reference entity defaults, then protection buyer will approach the protection seller to reimburse for the loss. Okay, but we also saw a risk where what did they have? They had counterparty risk. What was counterparty risk? Okay, what is counterparty risk? Yes, reference entity defaults, then the protection buyer goes to the protection seller for compensation. But protection seller is also now bankrupt. Then protection buyer will lose on reference entity and lose on the premium paid to the protection seller as well. Okay, to mitigate this counterparty risk as well, you can come and approach a CLN. What happens here is, yes, you have an asset. Okay, you have an asset that you have invested in. You're the bond owner, you're the investor. Okay, but you know you are exposed to a credit risk. Why? The interest and the principal should come from the bond issuer. Okay, now you want to transfer that credit risk. Okay, you want to transfer that credit risk, but you also want to mitigate your counterparty risk as well. Okay, so what do? You get the help of underwriters here. Okay, you get the underwriters who will use this bond, this reference asset here, who will use this bond and issue another security to the CLN buyers. Okay, they will issue securities to the credit linked note buyer. Now, what is the security that they sell? They sell credit linked note. Okay, they will sell a credit linked note. And when the CLN buyers buy it, you will get money, right? That money will go to the bond owner. So upfront, even before a default incident, the bond owner now gets the cash. So this allows the bond owner, the protection buyer, to be safeguarded from counterparty risk. Why? There is no risk that this CLN buyer won't pay. Why? Upfront you have collected all the money. Okay. Therefore, counterparty risk is mitigated. If a default happens, what happens? If a default incident happens, that will now, if this default happens, underlying asset is also defaulted. Therefore, the default risk goes to the CLN buyers, not to them. Okay. It is the CLN buyer who takes up the default risk. Credit deterioration risk is also borne by CLN buyers. Why? If this instrument is downgraded, then this instrument is also downgraded, and that will impact on the market value of their instrument that they hold. Okay. Counterparty risk, that is also borne by CLN buyers. Why? Now the bond owner is not facing any counterparty risk. He has already collected the money. Okay. CLN buyer now depends on the bond owner. Why? When this bond issues the repayment, that repayment has to be paid to the CLN buyer by the bond owner. If the bond owner doesn't repay, then the CLN buyers won't get their return. Okay, that's how they assume default, credit risk, and also they assume counterparty risk. Now here, what I have mentioned here as no downgrade, default is how the payment works. Let's say there is nothing, no any variation. Okay, then the rate of return is higher to the CLN buyers. Let's say there is a downgrade event, then because the risk has materialized, the rate of return offered will be lower. In the downgrade, that's the risk, right? That risk is now passed to the CLN buyers. Initially, that risk was with the bond owner. Okay, let's say there is a default occurrence. Then again, default occurrence, the bond owner will not face. Bond owner will now pass it to the CLN buyers, who will only get a recovery rate. Okay. So from these arrangement, what is the difference between CDS and CLN? Both CDS and CLN help to transfer credit risk. Okay. Both of them transfer credit risk. But major difference is CLN is funded. What do you mean by funded? Upfront, you get the money. In CDS, it was a non-funded credit derivative. It's more like a fee arrangement. That credit derivative you have to pay as fee. But here, it is completely funded. You get the money upfront. Okay. And another difference is bond owner is not exposed to counterparty risk. Who is now exposed to counterparty risk? It is the CLN buyer who is exposed to the counterparty risk. Okay. Now, because of this, you don't need another insurance provider to this arrangement. Bond owner doesn't need any insurance. Why? They already get the money upfront. They no need to insure for anything. They get the money upfront. If there is any default, then the default is passed to the CLN buyer. Okay. If the CLN buyer wants, then the buyer can get a CDS if they want. Okay. But other than that, the bond owner doesn't need to get any CDS. Okay. That's how a credit linked note works. They are able to transfer the credit risk and get the money upfront. Now the credit risk is with the CLN buyer. Now let's say when these people issue the security, then the CLN buyer could approach or get a CDS to cover for the credit risk. Why? Now CLN buyer is exposed to the credit risk. He has the credit risk. What if this bond owner doesn't repay? Okay. So this CLN that is sold could come with a CDS. Okay. There could be an embedded CDS to the arrangement so that the CLN buyer is protected. The bond owner doesn't have to get any CDS. Why? He or she doesn't have to bear any credit risk. That's how a CLN and a CDS actually differ. Okay. So with that, we finished off securitization, and now we'll be going through financial market crisis. Before we go through derivatives, why I'm going through financial market crisis is because structured finance product is something that you need to know before we move to financial market crisis. Why? 2008 financial market crisis is one of the biggest global financial crisis that we had to face, and that was due to such a product. Okay, so having that knowledge and moving to financial market crisis is much more beneficial. So what is financial market crisis, or what is financial crisis? When we say financial crisis, what are we referring to? We are referring to a drastic loss of asset value. Some kind of asset, it could be equity, debt, it loses its value, but in a drastic manner. Assume in a single day, it loses 50% in value. Then you refer it to as a financial crisis. Usually financial crisis associated with a bank run. When you have a bank run, what do you mean by a bank run? Due to some kind of a panic situation, all the depositors approach the bank and try to redeem their deposit. Okay. And when they redeem their deposit, what happens? You have to repay the deposit, right? The bank has used the deposit to give out as loans and advances. Those loans and advances are for longer term. So some deposits you can repay because you hold certain proportion as liquidity. But after that is over, you are unable to pay other deposits because those are invested in long-term assets. So that will result in bank runs where the bank will have to upfront recall on certain loan at a loss or at some kind of a capital cut, and that will impact the bank. Okay. So when a financial market crisis happens, what essentially occurs is investors panic. Okay, they panic and they start to sell their asset, let it be equity or bond. They want to have ready cash. They panic because they assume having any financial instrument is going to impact them. Okay, is going to be of more risk because the financial instruments are losing their value. So they want to have their money back in notes and coins. Okay, so they start panicking, selling their asset, and that's why they quickly withdraw any kind of cash that they have with financial institutions. Okay, this happens in a panic situation. What now? This is they're trying to get their money out. Okay. Other part is if you have a borrower, if you are a borrower, and during a financial market crisis when asset values are collapsing, okay, that will essentially create a bank run. Yes, you will also sometimes lose out on your payments, on your income. That will then create a default on your mortgages, default on your loans. So think from a bank perspective, you have increased default, loan defaults happening, and on the other end, so many people are demanding their money, deposits. Then to a bank, it's a real crisis. Asset is being wiped out. On the other hand, liabilities are being recalled. Okay. So this is called a crisis situation. Situation when the value of financial institutions or their assets drop rapidly. Okay. Financial crises are usually associated or stem with some sort of a panic situation, some sort of a bank run, okay, where they want to get out, take their money out and hold it by themselves without holding it in a bank. Why? They think the bank might use their money to pay somebody else's deposit. Okay, so to avoid that, they want to get their money out and they don't want to have it in financial instruments. Why? The instruments are collapsing in asset value. Okay, so this essentially starts with a panic and a bank run. For example, during this COVID lockdown situation, moment there were global lockdowns, there were announcements by certain countries for a lockdown. They assumed something like that would happen internally. Production will fall, we will run out of food. You could imagine what kind of a supermarket run that they had. All the supermarkets were wiped out, products were wiped out. It's not a shortage, but they started panicking. For example, the toilet tissue panic situation globally. Okay, there is ample products available, not a shortage, but a panic situation creating a crisis. Okay, now in a financial crisis, usually this collapse in asset values happen because of a bubble situation. Even recently, if you heard news, latter part of last year, and so you would have heard this word called bubble, asset bubbles, real estate bubbles. Okay, so when there is a bubble situation, usually that bubble creates a financial crisis. Not because there is a bubble per se. If the bubble bursts, then a crisis situation occurs. Let's now see what this bubble is. Okay. A bubble is a sudden escalation in market price of a product, instrument, or some kind of asset that is not warranted by the fundamental demand requirement. Okay, not warranted by the fundamental forces. For example, let's say this bottle is around 35 rupees. Okay, suddenly there is a supply shortage. Okay, so there's a supply shortage, or let's say there is something wrong with the water that we are getting. You only have to buy mineral water bottles. A sudden spike in demand. Okay. So when something like that happens, all of a sudden this 35 rupee bottle will become 100, 200,000. Why? There is a sudden spike in the demand, or there is a sudden collapse in the supply. Okay. This creates the market price of a certain product, certain asset, or certain financial instrument to increase or to surpass the price determined by the fundamental sources. Okay, and that escalation is by a significant amount, and it stays in such a escalated price for a very long time. Okay, for example, if you came across the real estate bubble article, so many people were predicting that the escalation in the real estate prices is a bubble. Why? Within a shorter period of time, especially in Colombo areas, the real estate prices took a sharper increase. Let's say it was at 10 million, now it's going at 35, 40 million. Okay, such a huge escalation, but now it's going on for a very longer time. Why it's a bubble? What do you mean by a bubble? Something small, you grow it out of proportion. When it blows, when it becomes bigger, bigger and bigger, at one point it cannot go beyond that. Then it will break. Okay. So this increase of larger proportion, when it breaks all of a sudden, it impacts the confidence on the market and it creates a shock in the market. Okay. That's why bubbles are very, very scary. When a bubble situation occurs, even the central bank and the other economies have to manage the situation very carefully. Okay, why would this bubble situation occur in the first place? Two reasons are given. One is a low interest regime. Now currently what regime are we in? We are having a low interest rate regime. 5%, 6% is the interest rate. Okay, so at that time it's easier to borrow. So because it's easier to borrow, what will you do? You start demanding. You start purchasing. This demand, is it because of a fundamental increase? No, it's because of the interest rate regime. Moment the interest rate regime changes, the demand will collapse. Okay. So due to a low interest rate regime, and the demand is increasing, there's a high chance for you to get a loan easily and go and invest. Therefore, the price will start to expand, creating a bubble. Other two reasons are obviously supply shortage and demand pool inflation. when there is a sudden shortage in the market. Now, for example, recently what happened, you will have seen the Suez Canal, there was a ship that was stuck. Okay, if you don't know, read up on that. In the Suez Canal, which is one of the important passages for international trade, a ship was stuck. Okay, if you were able to see the marine traffic at that time, a lot of ships were blocked. I hope I should be able to show it to you. Okay. I'm unable to get it for you. Because that's one of the interesting things that you need to see. This is the pic of it. You can see here. This is the narrowest passage for you to travel between the Red Sea and the Mediterranean Sea, so that from Asia to get to Europe, it's one of the easiest passages. Okay. So here you can see the ship has entirely blocked. Okay. Due to this, what happened? The ships coming from Europe couldn't come to Asia. Ships in Asia couldn't go to Europe. Okay. This situation, now this is a real situation. Okay. This created a supply panic. Why? Countries which were dependent on import had to get their material down. Okay. Initially, they didn't know how long this ship will be stuck, so that supply will resume back to normal. Now this ship was stuck for more than 2 weeks. Okay, so during that 2 weeks, people were panicking, and there was a supply shortage. Not say now during the 2 weeks there was ample supply actually, but people imagined a possible shortage and started panicking and started demanding more quickly. They wanted to keep stocks of it internally with them. Okay, this created a supply shortage. Why? If you buy one packet of rice now, because of a possible shortage that you think will happen in the future, now you're buying 2 or 3 at once. Obviously, if you buy 2 or 3 once, it will create a supply situation, supply shortage now itself. Okay, that is another possible cause for a bubble. What about demand pull inflation? Demand pull inflation is you have a sudden spike in the demand. Could be because of low interest rate regime, could be because of a possible supply shortage. You suddenly see a spike. Now, in the real estate segment, post-war, we saw this spike coming in. After the war was ended, we saw a lot of demand coming in, foreigners coming in to stay, a lot of migrants, a lot of Sri Lankans who left Sri Lanka coming back to Sri Lanka to stay in or to purchase some land for their purposes. This created a sudden demand which was not there before. Okay, and due to this, again, there was a larger escalation in the asset prices. So a bubble is like the starting point for a financial crisis. What are the other causes for financial crisis? Relaxing lending rules. For example, let's say earlier they had let's assume earlier there were regulations where that Now, even currently, if you are in the crib, meaning if someone gets the crib report and it's a bad crib report, you have defaulted several other banks' loans and advances. Okay, then essentially banks are not supposed to give you a loan, or the new bank is not supposed to give you a loan unless you settle the bad debt of another bank. Okay, unless you settle the other bank's bad debt and then approach this new bank for a loan. The banks don't usually consider such bad crib report customers. Let's assume there's a regulation brought in where they say you can disregard that or you can still grant. Then what happens? Then even the bad debtors will now come and try to get more loans, create a demand in the market and not pay the loans, create a high NPL situation and eventually lead to a financial crisis. Okay, that's one way of thinking. So relaxation of lending regulation is also another possible avenue that could create a financial crisis. High leverage or high liquidity. What do you mean by high leverage? You take on more debt. When you take on more debt, there'll be a time where you're unable to meet that debt. What I mean is, let's say you are doing a job. Your income is 10,000. Okay. You take one loan for 1 million. You take another loan for 2 lakhs. You take another loan for 5 lakhs. Like that, you have about 10 loans. All these 10 loans have to be paid from your 10,000 monthly salary. Can you do that? Impossible. Maybe you can for the short term manage it. But if your inflow is unable to meet with your obligation, it creates a highly levered situation, essentially leading to a collapse and a crisis. High liquidity. When you have too much of cash floating in and around, then what happens? It creates a high demand. That demand could end up in a crisis as well. Why? All of a sudden you have a lot of liquidity in the market, a lot of demand is coming up, and now this is a money back demand. Due to the money circulation is high, the demand is more. Okay, if the supply is unable to match to that demand, then it will create a high escalation in prices, causing a crisis. Poor credit evaluation or credit worthiness of the borrowers, we saw that earlier as well. If the banks keep lending to bad borrowers, then the deposits of the customers are being given out as bad loans. Then it will create a crisis situation to one bank, which would essentially be resulted in a bank run and causing an industry-wide impact. Borrowers unable to pay. If your borrower is unable to pay, again, that creates a much higher concern. It's not because of, it could be because not poor credit worthiness or not poor evaluation, but due to a market situation, suddenly your borrowers are unable to pay. Example, think about the COVID lockdown. During that lockdown, the day job earners, businessmen had to close down their business for some time. During that time, what happened to the loans? They are unable to service that. They don't have an income. Then, thank God, central bank stepped in, provided some kind of easement in terms of moratoriums. If not, then it will end up as a bad day and create a system-wide or an industry-wide impact. Okay. Failure of banks and financial institutions is also another cause of a crisis. When a major banks collapse, what happens? When one major bank collapses, it creates a panic in the market, which ends up in a bank run. Or possibly, if one bank collapses, Due to closer ties with the other banks in the industry, there can be replicant effects. Okay, due to that, other banks might also suffer. For example, during the past time, when there was a golden key issue, you would have seen golden key, the finance issues. You would have seen central bank stepping in to ensure that Ceylon Bank was operating correctly. Why? They were worried about the replicant issue that the bank would have. Even people were panicking and trying to go for a bank run issue, even though the bank was still being managed correctly. Okay, so why did they step in and ensure that the bank is operating correctly to avoid any replicant? Because if something bad happens to that bank, there could be other replicant effects on other banks as well, which would then lead to a crisis. All right, so these are the causes for a crisis situation. Now, when there is a financial bubble, so how does a crisis happen? Initially, you have a bubble situation where the market price of a certain asset or product is blown out of proportion, exceeds the fundamental price. Now, for example, if you go somewhere, you would hear some price of a product, and you'll be wondering, my God, is that the price of this product? Like, this is not the market price. I mean, this is not worth that much, correct? The price would be higher than what it's fundamentally actually worth. Okay, so that essentially is a bubble. Just because you have a bubble, does it create a financial crisis? No. When the bubble bursts is when a financial crisis occurs. Example, let's say there is a sudden escalation in prices, and in one incident, there is some known person or certain economist coming in and commenting on it, or let's say some strict regulations are put in to avoid further price escalation. Suddenly everyone starts to sell. Okay, then what happens? There is a collapse. The bubble is burst. The price is not growing anymore. The bubble is burst. Price is now declining. Then it causes a sharp decline in the prices, creating a financial crisis. Okay. Now, financial crisis can happen in one country, one market. But when it spreads to other markets, other countries, you call it financial contagion. Now, contagion, if you have watched the movie during this COVID time, you would see what is a contagion. It's something negative be spread across. Okay, so financial contagion is a crisis that happened in one part of the country, one market, or in one country being spread to other markets. Now see this image. The collapse happens in Wall Street, but it creates a collapse in the other capital markets as well. Okay, the spread of negative market disturbances from one country to another. And how is this passed? How is a crisis in one country being passed on to other countries? Why? Because there can be co-movement, there can be dependent on this country. Okay, let's say exchange rate of US depreciates, simultaneously another country which is pegged to the US dollar will also get depreciated. Okay, so due to the co-movement in exchange rate, in stock prices, in sovereign spread, in the return, in capital flows, the spread of the negative market disturbance could happen. For example, financial crisis. Crisis that started in US spread all across, impacting the entire global situation, entire global or entire countries. Okay, started moved to Europe, again Asia, China, everything had a replicant effect of that. Okay, so that is what you call a financial contagion. So how can financial contagion happen? In other words, how can a shock in one country, one market, trickle down, pass to other countries? Okay, even though the points are given here, I would have given you the elaborate notes. Yeah. So causes for financial contagion. Most common cause is a common shock. Let's say crude oil prices collapse. Okay, crude oil prices collapse. It's a common shock to all countries which are crude oil dependent. Okay, so every country which is dependent on crude oil will face the effects of it. Okay, especially if you had someone who was hedged against the crude oil price increases. Okay, that is called a common shock. Certain incident, that occurrence is a common factor. That occurrence is commonly impacting all the countries. Therefore, at once all countries are impacted. Okay, trade links and competitive devaluation. Due to trade links, also a contagionary effect can happen. Example, let's say one country which is the largest importer. Okay, let's say a country A is the largest importer of gold. Okay, they import the largest quantity of gold from another country. Okay, all of a sudden country A is facing a crisis. Okay, during that crisis, there's no demand for gold, therefore they are not importing gold. The import of gold is now dropped drastically. What happens to the other country which is exporting gold to this country? Their exports are now impacted. Okay, when their exports impacted, that country will also get affected. That's one way. Another scenario is, let's say country A and B. Okay, country A invests in country B as foreign direct investments. Okay, there's a lot of investors in country A who are keen in investing in country B's upcoming projects. But if country A is facing a financial crisis where everyone wants to realize their money, take their money out from the banking system, keep it as cash with them, will they go and invest in country B at this time when there is a crisis? No. Then what happens? Country B will not get any fund inflows, and due to that, country B will also be affected. Okay. Competitive devaluation. I told you that earlier as well. If US currency gets depreciated and if another currency had pegged their exchange rate to the US rate, then their exchange rate will also get impacted. Okay. Liquidity and incentive problem. Liquidity and incentive problem meaning now locally also a dollar issue. When the forex lines are now, you can see locally our exchange rate is getting depreciated in a sharper manner. Okay, this situation now when we are facing a depreciation issue, imports are impacted, and due to that impact will come to that if we reduce on import, the exporting country will face that issue. Okay, decline in equity prices. Okay, when equity prices are declining, what happens? No one is coming to sell. Liquidity issue comes in. Okay, that also creates a financial contagion. Local equity prices collapses, then even the international investors who have exposure to our market will face the consequences. Okay, other one is informational asymmetries. There is a financial crisis, but let's say it's not so big. Okay, it's not so huge, but because we do not have, the other countries don't have the correct information, okay, they could view that as a much bigger crisis, and they could face the similar impact. They don't know the real nitty-gritties of that. Okay, due to that informational asymmetry, the investors, or let's say the market participants in another country, will assume that they will also face the same consequences, and that will eventually materialize. Example, the COVID situation. When we saw supply shortages coming abroad, we assumed that will happen locally as well, and started demanding at the moment, panicking, and that actually created a shortage in our market as well. Okay, market panic and loss of confidence, that's also another cause for a financial contagion. When one country is going through a financial crisis, other country or another sector can panic, and they might not have confidence of a recovery, and this will create a contagion situation, bad situation for that country as well, causing a spread of the negative market disturbance. Let's say bank in country A is collapsing, and that bank has a huge, let's say, it's a huge banking relationship with a country with another bank in country C. Okay, C will start panicking. Even though C doesn't panic, let's say depositors of C will panic and start drawing the money out, creating a bank run, essentially causing the same crisis to the country C. Okay, so market panic and loss of confidence is also another area, another way that this financial contagion could happen. What are the after effects or consequences of a crisis? So when a crisis happens, what are the consequences of that crisis? First, the economy will start moving into a recession. Why? What do you mean by a recession? When during 2 or more quarters, the economic growth of the country is negative. In other words, the production of that country is decreasing. Demand has dropped and supply is also declining. Okay, the production levels have decreased. When the economic activities are declining, why? Now they don't have money. Okay, due to that, financial crisis meaning drop in the asset prices. Asset prices meaning they lose out on their income, their gains. Then that will create a hit on the production, country's economic activity. Will you consume more? No. You don't have money to consume. Then your demand is hit. Demand declines. Companies will go through a bad time as well. Why? They don't have demand for their products. Okay. So immediate consequence could be a recession. Okay. Following recession, you might end up with unemployment. Why? When there is not more production happening in the country, why do you need laborers? There is no, by having 100 employees, you're not going to produce the same quantity as before. So might as well get rid of them. So unemployment starts to escalate. Deflation. You're not demanding for certain products. Demand is declining. Therefore, prices of the products will also start to decline. So there could be a reduction in the level of inflation. Initially, the inflation rate will start declining. Let's say Earlier, if it was 4-5%, now it will be from 4, it will come to 3, it will come to 2. Like that, the inflation, the rate of the inflation will start to, the level of inflation will start to decline. Bank runs. You're scared of that crisis impacting you. You will lose out your money kept in the bank. You will run to the bank to withdraw that. Why? Holding money is more important for you now. Financial outflow from markets. Let's say certain countries going through financial crisis, just like what the citizens of that country want to take the money out from the bank and safeguard. International investors want to take out their money and move out from the country as well, so that they can avoid exposure to the crisis. That will create a financial outflow. Finally, when all these materializes, it will create social unrest. People are unhappy, unemployed, recession, deflation, no much money, loss in asset values. That will create an unrest in the economy. Cost of financial crisis. By going into a financial crisis, what are the costs? Who pays the negativities or the essential cost or the loss from a financial crisis? Now, whenever there is a financial crisis, the role from the government is very, very important. Okay, what do? They will initially step in to support the financial sector with several rules and regulations. Okay, they might come in, and when there's a bank run, they might intervene and say no more withdrawals other than 10,000. Okay, they could limit it. Okay, they could curtail it so that even the people will take a moment to ease out. Okay, now this support to the financial crisis can happen in terms of regulatory measures, or can happen in terms of liquidity injections to the system, where they give out money to the financial sector. Okay, so that they are able to meet the increasing withdrawal requirement. Okay, asset purchases and direct lending by treasury. That's what we were looking at. Asset purchases meaning like a treasury bill purchase. Now, when our central bank buys the treasury bill, okay, let's say banks have treasury bills. The central bank says, look here, I'm willing to buy the asset from you, buy that treasury bill from you. Then what happens? Treasury bill goes to central bank. Central bank will pay you money. Okay, that money is new liquidity injected to the system. Abroad, you call this the asset purchasing program. What do you mean by asset purchasing program? Central bank will purchase the asset that they have sold earlier, like treasury bill or bond that they sold earlier. Now they are intervened and coming to buy it back. So when they buy the asset, they will pay cash, which means liquidity is injected to the system. Okay, that or direct lending by treasury. The treasury of that country will come in, so they will directly lend to banks so that they could use that as a loan to meet their increasing financial crisis situation. Let's say it's a bank run, the bank can borrow from the treasury and meet the withdrawal requirements. Loss of global gross domestic product and economic growth. That's another cost. What do you mean by cost? Another consequence. Your output is now declined. Okay, because of that loss of output, there is a loss borne by the corporates or the companies. So that's a cost borne by them. Increasing unemployment. Unemployment, loss of income is a cost borne by the general public. government bailout using tax money to bail failed entities. Let's say there are certain companies which have collapsed due to bank runs. Okay, certain banks. Then the government will have to bail them out using the tax money, which could have been otherwise used for country's development. Okay, lost household wealth. So if the asset prices are declining, let's say you invested in the stock market and all of a sudden the stock market is collapsing, you are losing the money that you invested, which means the wealth that the household has created or accumulated is now lost, is now evaporated due to financial crisis. Finally, human suffering. General public is the one who suffers from such crisis situation. Why? You can see from the global financial crisis, a lot of income lost, jobs are lost. They have no means to meet their requirements. Okay, essentially, it creates a human suffering in the market. What are the benefits of a crisis? Now, this you might be surprised to see. What do you mean by benefits of a crisis? Now, there are positives that arise from a crisis, but remember, these arise after the crisis actually happens. Okay, what are the benefits? Obviously, when a crisis situation happens, people realize the loopholes. They realize where they made the mistake. So introduction of a better governance to address that will happen. New regulation, law or new directions by central bank could come in. And enhanced supervision. They know, okay, this happened due to this situation. We should monitor that aspect as well. Okay, so essentially the benefit of a crisis situation is the country, the regulator is now able to identify that loophole, identify that something like that could possibly happen as well, and take measures to address that. It's more of a reactive policy. Okay, those three are the only benefit of a crisis. That I don't actually understand any other benefits from a crisis. Only better one is you will understand that something like that happened. Let's take a better regulatory measure. Example, Basel III. Okay, due to the issues of Basel II, we had global financial crisis. Okay, was Basel II able to curtail that as a regulatory measure? No. But financial crisis happened. Taking a learning from that, now they have come up with Basel III as a better mechanism. But currently, do we know the loopholes of that? No. If another crisis occurs, then again, it becomes another learning point to see another aspect. Okay. Now we are going to look at effects and signs of a crisis. So before a crisis happens, can we identify that? Are there any indications for that? Okay, so these are the indications. Decline in equity market and prices. If you see or if you witness continuous and sharp decline in equity market and prices, it's a possible indication for a future crisis. Because if there is a substantial decrease and people lose out their wealth, okay, then what happens? That's wealth lost, right? It becomes very hard to regain that. So essentially, it will create a financial crisis. Again, this is why they have something like circuit breakers involved, so that they could avoid panic situations. Panic situation, when you have prolonged panic situation, it could create a crisis. Drop in housing and real estate prices. I don't know whether you have come across it recently. There are certain contractors who betray on the contractors, especially on these apartments. But due to good sound measures available to compensate and avoid a panic situation, we are able to manage this effectively. If not, if there's a sharp decline in housing and real estate prices, it will definitely create a crisis in the market. That was the starting point for the global financial crisis. Why? The mortgage loans which were taken backing the houses, all of a sudden the housing prices started to decline. So it was easier for people to actually default on the loan because the house was not that worth it. They could buy a better house easily for a lower price. That created a much larger crisis to the entire world. Continuous declining financial sector profit. So if the banking sector especially is facing declining in profit continuously, then it's an alarm. Recently also, if you had seen, there was an article in FT where they spoke about analyze the banking sector profits. This is the article for you, 15th of March, where they analyzed the profitability for the last 5 years, and they noted how the profitability is kept on declining. Okay, so when you have continuous declining in financial sector profits, that's also a alarming sign. Decreasing commodity prices. When you have all of a sudden collapses in the commodity prices, again, that is also an indication of a possible crisis. Crude oil price collapses, declines all of a sudden, when certain asset prices, commodity prices decline, it could create a financial crisis. Increasing interest rate as a result of rising risk premium and depreciation in exchange rate. Now that's why even locally, exchange rate is a huge concern. I'm not able to see that article. There was an article on how we hit 202 rupees. Yes. 12 hours ago, when the dollar continuously hit this mark, it's alarming. This is the first time in history that the selling rate of a dollar exceeded 202 mark. So remember that when you have such high escalation, it becomes a possible financial crisis, because when you have exchange rates increasing so high, especially to an import dependent country, it will be very dangerous situation. Imported inflation could increase, causing a high risk situation. Okay, so when the exchange rate gets depreciated, essentially that will create the local interest rate also to increase. Okay, so that will create a financial crisis. All of a sudden, when there is an increase, when there's a U-turn in the interest rate, it becomes a possible opportunity, a situation of a crisis. Now, I told you, when there's a low interest rate, it's a cause for the bubble, right? You are able to borrow and demand. let's say all of a sudden the interest rate increases, you're unable to borrow and demand due to the high cost. Then all of a sudden the demand vanishes. Okay, and the person who borrowed also now will have to pay at a higher interest if it's a floating rate. Then possibility of a default, missing demand, which could create a financial crisis. Okay, so these are the effects or the signs of a crisis before it happens, the very early stages. I have also given to you the timeline of certain financial market crises, which were important in our history. So if you go through the note, you would find elaborate write-up on that. Okay. Read them so that you have a good understanding about why it happened, how it happened. Okay. Especially the global financial crisis, the reasons and everything, because it's a good way for you to understand how one country's crisis moved to the other countries, especially the crisis transmission, how it became a contagionary impact. Okay, and what were the reforms that came about, especially Brexit. Remember, Brexit was finalized in 31st January 2020, and by December, Britain moved out. So the entire market-related information or the crisis examples and why it occurred is given to you in the note. Have a good read on that. Okay. So with that, we are done with financial market crisis. And now we are able to move to derivatives. Now, derivatives is something that we are going to look at tomorrow, Saturday, our usual lesson. Derivative, I told you, is a part of structured financial products. Okay. Another component of it. Why do you call it derivative? Because the value of this instrument actually is derived from the underlying security. Okay. So if the underlying security is performing well, then there is a value for this derivative. Okay. A derivative instrument is a contract between two parties, buyer and seller, who agree to exchange some asset. So the underlying asset is always required. Okay, for cash at some future date at a predetermined price. That's essentially a derivative. Now you can have a derivative in terms of interest rate, stock exchange indexes, and even exchange rate. Okay, it's tailor-made, customized according to your requirement. But not all derivatives are customized as well. You will see four types of derivatives. Sorry, not credit derivatives. 4 types of derivatives. In that, fairly 2 are customizable, 2 are exchange dependent. Okay. Sorry, 3 are customizable. 1 is exchange based futures. Okay. So here, derivative, what you are trying to achieve, even in credit derivative, you are trying to minimize or eliminate some kind of a risk. In credit derivative, we are eliminating credit risk. Now, in this derivative as well, in every derivative, you are trying to mitigate some kind of a risk. Okay, that's why you have these derivatives. So the risk can be caused by interest rate changes, forex changes, and even commodity price changes. For you to minimize that exposure, you could use a derivative. Purposes of why you enter into a derivative. Okay. The very first requirement is hedging. What do you mean by hedging? You are exposed to a certain risk. Okay. Now, you want to reduce that risk, or you want to protect yourself from that risk. So essentially, derivatives were created for the purpose of hedging. Why? You want to protect yourself from that risk. Okay. So to do the hedging practice is where derivatives were actually introduced. But over time, they realized using derivatives, you're able to get you're not only able to protect your risk, but also you're allowed or you have the opportunity to earn a much higher return. Okay, therefore they started using derivatives for speculatory purpose. What do you mean by speculation? Here, you're not worried about the risk. You are willing to take a higher risk to earn a very high return. Okay. Now in hedging, you are worried about risk. You don't want to accept the risk. All you want is to mitigate the risk. You're not worried about the return. But speculation, you're willing to accept that high risk. Why? Your focus is on the higher return. Okay. Derivatives can also be used for arbitrage. What is arbitrage? Simply, arbitrage means riskless profit without exposing yourself to any additional risk. You're able to get a higher additional profit. For example, in Colombo, let's say one mineral water bottle is 50 rupees. Okay. But in Nuvarelia, one mineral water bottle is 30 rupees. Okay. Now, one person would be wondering, why am I selling it in Nuvarelia? I might as well go to Colombo and sell at 50 rupees and get 2 rupees more. So, without taking any other additional risk, they are able to just buy at 30 from Nuvarelia and sell at 50 at Colombo. That pricing difference allows the person to get a riskless profit. Now, this arbitrage is a short-lived profit. Why am I saying short-lived profit? Because now if I start that, I can buy from one market at 30, sell in another market at 50. If I start that, someone else will also look at that and say, good opportunity. We'll also do that. They will also do that. Another person will also do that. By that, what happens? In Colombo, there will be a lot of water bottles. Ideally, the price will now decrease. In our area, price of the water bottle is increasing. Why? So many people are now demanding. So essentially, the price will reach equilibrium, reducing that opportunity for a additional profit. Therefore, arbitrage is a short-lived profit. Okay. And arbitrage, if there is an arbitrage opportunity in a market, you call that market inefficient. Right? If there is an arbitrage market, then there is a price difference. Right? But because you engage in the act of arbitrage, the prices will now match, creating or contributing towards market efficiency. Okay. So derivative as a financial product, you can use it for hedging purpose. You can use for speculatory purpose. You can use for arbitrage purposes as well. Okay. Three of these purposes are different from each other. One only wants to reduce or mitigate the risk, not bothered about the return. Speculation, you are keen to take high risk. Why? Your focus is on the higher return. Arbitrage, your focus is on earning riskless profit. All right. So what are the main types of derivatives in our market or even the global scenario? Forward contracts, future contracts, options, and swaps. These four are the essential and the most fundamental derivatives in any market. Okay. Now, we don't have time to get into each of these segments in detail, but let me give you a brief overview here. Forward contract is customizable. Okay, customizable, but it's an obligation. If you buy this contract, you have to honor this contract. You can't get out of it without honoring. But depending on your requirement, the contract can be tailored. The contract given to you will be different from the contract given to me. Okay. Futures contract is a uncustomizable contract. That means it's traded through an exchange. Okay. It's standardized. It's given in certain quantities. Only in those quantities you can buy. Okay. Options is a customizable product, customizable derivative, and you have an added benefit. Now, forward contracts were obligatory. You have to honor them. But in options, you don't have to abide by that. You can get out of it. You have the option to decide whether to execute or whether to decline. Okay. Swap contracts. What do you mean by swap? You're trying to exchange. So in swap, you're able to exchange something that you are exposed to with another party. Okay. That's the summary of these four at the moment. So tomorrow in our class, in our usual time, we will go through all these four types in detail, especially the futures contract, where we will look at how the margins work, how the calculations work. Then we'll give a huge focus on options, types of options available, how do you decide whether option is lucrative or not, how do you see the profit and loss of options, how do you price options, or not how actually, how can you assume whether option has a high price or low price, what are swaps, okay, what are the common types of swap? We just saw one, credit default swap. Okay, but here our focus is on interest rate swap. How does it work? And then we move to foreign currency swap. How does that happen? Then we move to another type here, cap flows and collars. How a cap, a flow, or even when you have a collar agreement, which means you have both, you have a cap and a flow both. How will that help an investor mitigate or transfer the risk to another party? Okay, so tomorrow's lesson is very, very important. I request you all to join in so that you could understand the derivative chapter easily. Okay, so thank you so much for listening in today. Tomorrow during our usual time, we will again meet. Okay, thank you.